Well, hello, and welcome back to Principles of Accounting 2. I'm still your host, Dr. B. We just got done with a conversation on budgeting, master budgeting, and understanding what goes into that process. Now I want to talk about more budgeting stuff, but I want to talk about what it means to be flexible in budgeting, and I also want to show you the process of comparing the budgeted amounts to the actual performance and how to correct underapplied or overapplied budgets. So here's how it works. I'll show you how all that works. So let's go ahead through that process, and I'll show you everything. First and foremost, we talked about master budgeting just now, and there are really two different kinds, approaches, I should say, to budgeting. There's the fixed budget approach and the flexible budget approach. Some companies, mostly government agencies, use what's called the fixed budget approach, also known as the static budget approach. And this is based off of single predicted amounts of sales or other measurable activities. That's why earlier when we were talking about budgeting in the previous chapter, I had talked about how government agencies spend up to the amount that's allocated to their budgets, right? That's because they follow the fixed budgeted approach. It's just they receive the same amount each year, typically. Sometimes a little higher or lower, but it's fixed. That's the amount they get. And they try to spend up to that amount. That's what governments do. So most government agencies and a few companies follow the fixed budget approach. I'm sorry. Yeah, government agencies and a few companies follow the fixed budget approach. Almost every other company, at least most companies in the private sector and public sector for that matter, follow a flexible budget approach. And what this means is I can budget based off of different factors and with the expectation that my sales will be different every month. That's flexible. That's the flexible approach. I look at every single month differently. I say, okay, it's a new month. I expect to sell this amount. I expect to sell this amount next month. They're different amounts, right? That's the flexible budget approach. And I can budget based off of those expected sales each month. So on a monthly basis. So that's the difference between the two. Now, when we've established a budget, it's so important to identify the differences between your budgeted amount and your actual performance, your actual results. You have to know the differences. We call those differences variances. The word variance means difference. The difference between, that's a variance. We look at the difference between the fixed amount, the budgeted amount and the actual results. We're going to look at both approaches, the fixed approach and the variable approach. Variable approach. The fixed budget or static budget is based off of single amounts. What that means is they're based off of a fixed dollar amount. Okay, I'm going to sell this much for the year. Boom, that's it. And so I base everything based off of those sales for that amount. So I'm going to say, hey, I'm going to sell $100,000 for the year. Okay. I actually sold 125,000. That's good, right? I sold more than what I expected to sell by $25,000. That's a good thing. That's why you see the variance is 25,000 F. F means favorable. Okay. When your actual sales are higher than what you expected, that's favorable. If the actual sales were less than what you expected, that would be unfavorable. You don't want that. So I need to calculate my variances for pretty much everything. Okay. Sales, cost of goods sold, direct, everything that's involved, cost of goods sold, direct materials, direct labor, factory overhead, selling administrative expenses. I need to figure out the variances. So I take in most cases, I take the fixed amount or the budgeted amount minus the actual results. That gives me the difference. So 25,000 favorable for sales because I sold more than what I expect to sell. It's favorable. But you'll notice everything else is unfavorable. Direct materials. I expected to have direct materials 10,000. Actually came in at 13. That's 3,000 unfavorable. Why? The answer is if your actual costs are higher than what you budgeted for, that's not good. It means you spent too much. Unfavorable. So 13,000 minus 10, that's 3,000 variance unfavorable. Direct labor. I budgeted for 15,000, came in at 20. That's 5,000 unfavorable. Why? Because you spent more on labor than what you said you were going to. Factory supplies. I'm over $100. Unfavorable. Utilities. I'm over by $1,000. Unfavorable. Sales commissions. I'm over by $1,800. Unfavorable. Remember, if you're anything you're spending money on, if you go over than what you budgeted for, that's unfavorable. And so at the end, we total everything up. Our net income. Our net income, we budgeted for 12,000. We actually got in 25,400. That's favorable. Why? Remember, net income is like your profit, yeah? And when your profit's higher than what you said it was going to be, that's a good thing. So it's favorable, 13,400. Your total expenses, definitely not favorable. You're way over on your expenses. You're 11,600 over. But your net income is higher than what you said it was going to be. That's a good thing. So remember, when the money coming in is greater than expected, that's favorable. But when the expenses going out are higher than what you expected, that's unfavorable. So that's how variances work. And so that's an example from a fixed budget approach. Flexible budgets, on the other hand, which is what most people use, gives us the ability to be flexible at different levels of activity. Now, if I sell 100,000 units, I expect to sell 100,000 units. If I sell 110, that's like the high level, right? 100,000, that's what I expect. That's at like 75%. If I sell 90,000, that's at the low level of activity. So 90,000, 100,000, 110,000, those are my expected levels of activity. Those are my ranges, we can say. Those are my ranges. 90,000, 100,000, 110,000, those are my ranges. And I can adjust my uh, expenses based off of those levels of activity. I'm going to show you how that looks. With a flexible budget approach, my total costs change with the level of output. Remember? Your variable costs change with the level of output. Your fixed costs don't change. Your fixed costs are your salaries, your rent, your some portions of factory overhead. Those don't change. They're the same. But your variable costs, those change with the level of activity. The more units I produce, you know, uh, my variable costs go up with those, right? So if it's $20 per unit, it's still $20 per unit, but the difference is I made more units. So therefore, my total variable cost went up. I can be flexible in knowing that when I create a budget that is based off of levels of activity. So here's what a flexible budget might look like. Think of it like low, medium, high. So we have our flexible budgets. This is an example of a flexible budget. I have low, 10,000 units. Medium, 12,000 units. High, 14,000 units. You take the number of units you expect to sell times the variable amount to get the total sales amount. You do the same thing for the rest of everything else, variable costs, fixed costs, etc. Well, I mean, the fixed costs don't change, right? Because they stay the same. So your variable costs, your variable costs change with the level of output. That's why they're called variable. Direct materials, direct labor, factory overhead. All those things change with the level of output. The more you make, the higher those costs are going to be. So there's that part, which also changes the contribution margin. Sales minus your variable costs equals your contribution margin. You know that. We've talked about that a few times. The only thing that doesn't change, regardless of the level of output, are your fixed costs. Things like depreciation for machinery, supervisor salaries, insurance expense, etc. These are all things that you still got to pay it, even if you made 0 units or 50,000 units, you still will have to pay the same amount. That's why it's a fixed cost. So this is the budget for your for a flexible budget. Now the month goes by or the year goes by, and based off of the levels, 10, 12, 14,000 units, I can then compare the actual performance. I said I was going to sell 12,000 units for one of my levels, which is $120,000, $10 per unit sales price, times number of units, 12,000, that's 120,000. I must have sold more than that. I sold probably, a few more than the 12,000. I ended up with 125,000 actual sales. That's favorable by $5,000. My actual sales were greater than my budget amount. Favorable. But because I sold more than the one I budgeted for, there's going to be a couple of costs that will be unfavorable. My direct materials, I'm over by 1,000. Budgeted for 12, came in at 13. Unfavorable by 1,000. Direct labor, unfavorable by 2,000. Budgeted for 18, came in at 20. Factory supplies. Shockingly, I used a little bit less, so that one's favorable. Utilities. Electric bill was high that one month. So I'm over by $400, unfavorable. Shipping expenses. I budgeted for $4,800. I actually only used $4,300. So it's favorable, $500. Remember, anytime that your actual is less than your budgeted amount, if it's an expense, it's favorable. Anytime that your actual expense is greater than the budgeted amount, then that's unfavorable. That's the way of thinking about it. For total variable costs, I planned on spending $57,600. I actually spent $59,400. That is unfavorable by $1,800. Contribution margin. Remember, sales minus total variable costs equals contribution margin. My contribution margin is favorable by $3,200 in this example. My fixed costs, most of them were the same, except I had an employee file a claim with my insurance. So the actual results came in higher than the budgeted amount by $200. But all in all, contribution margin minus your fixed costs equals your income from operations. My income from operations was higher by $3,000. That's favorable. That means I brought in more than I had planned. Now, you're going to hear me use a couple of terms. You're going to hear me use the word standard cost, and you're going to hear me use the word actual cost. Standard costs, think of this as the budgeted cost, the expected amount. I expect it, it's standard. I budget, it's standard. This is what it normally costs me, it's standard. All those words can be used to describe standard costs. We expect it, it's standard. That's how I want you to think of that. I expect it to be this amount. That is the standard cost. That is the usual amount I pay, standard cost. Think of it as the benchmark amount. This is what I normally pay, standard cost. But we know that the actual amount that I pay is either going to be higher or less than the standard cost. And that happens with direct materials, direct labor, factory overhead. Now let's look at direct materials first. And then we'll look at direct labor and factory overhead. So for standard costs, in order to understand what your standard costs are, we look at the normal price, the standard price, and we look at the normal quantity, the standard quantity. If going back to the previous chapter, remember the hockey stick company? They make the hockey sticks. Well, when we were talking about that, they normally use half a pound of wood for each hockey stick. That's their standard quantity, is half a pound. Their standard price, I think it was like $1.50, something like that, right? So that's their what they normally spend. So you could say standard price times standard quantity would get you the direct material standard. For labor, we take the normal labor rate for our employees, or the average labor rate for our employees. The hockey stick example, $12 per hour. And the amount times the amount of time it takes to make a hockey stick. Remember, it was a quarter of an hour, 15 minutes. $12 times 15 minutes, or 0.25, will give you your standard for direct labor. And we can also figure out the standard for variable factory overhead. We take the standard factory overhead rate times the activity standard to get the variable overhead standard. That's how we set our standard prices. So let's look at a different example. We're making baseball bats now instead of hockey sticks. We could also do hockey sticks, but baseball bats or baseball cards. I'm sure. Whatever. Baseball bats. I like bats. Okay, so we make baseball bats. It takes me a kilogram of wood to make a single baseball bat. A kilogram of wood costs $25. That's the standard price for a kilogram of wood. So $25 direct materials. That's my standard cost for direct materials. For direct labor, it takes me 2 hours to make a baseball bat at a rate of $20 per hour for the employees. Gets me a total direct labor, standard direct labor, $40 per baseball bat. Factory overhead. I apply 2 labor hours as my predetermined overhead rate times $10 per hour applied overhead rate to get me to $20 of overhead per baseball bat, standard cost. So standard direct material plus standard direct labor plus standard overhead is $85 per baseball bat. That's my standard cost. The standard costs, of course, help us we call those the budgeted costs. That's what I want you how I want you to think about it. Now we know that our standard cost is there, but we also know that our actual cost is probably going to be different. That's called a variance. When there's a difference between your actual cost and your standard cost, or your budgeted cost, the difference is called a variance. As I had said earlier, if the actual cost is greater than the standard cost, that's not favorable. Okay. If the actual cost is less than the standard cost, it's favorable. Remember, cost is different than revenue. If with revenue, sales, if your actual sales are greater than your estimated sales, that's favorable. That's sales, though. But for cost, if your actual cost is greater than your budgeted cost or your standard cost, that's not good. That's unfavorable. If your actual cost is less than your budgeted or standard cost, that's favorable. In order to figure out your variances, you have to go through a couple steps. First, you prepare your reports by looking at your income statement and figuring out the variances. Second thing is you figure out the variances, analyze the variances. The third thing you do is figure out why the variances happened. And the fourth thing you do is fix the variances to prevent them from happening in the future. That's the process. How do we compute the variances? Well, we're looking at the actual cost and we subtract the standard cost to get the variance. Well, that's the easy way to do it, yeah. It's a little bit more complex than that. But very simply put, actual cost minus standard cost equals cost variance. That's easy. But you got to know, how do you get actual cost and standard cost? Okay. Standard cost, we already talked about that. It's the standard quantity, the amount I normally purchase. the amount I normally use, standard quantity. Baseball bats, what I say, a kilogram of wood. That's the standard quantity. The standard price for a kilogram of wood is $20. That's the standard price. But I also know that the amount I actually pay is probably going to be different. The actual cost. The actual quantity might be different. I bought 2 kilograms of wood instead of 1, or a kilogram and a half instead of 1. So the actual quantity might be different. Actual price, cost of wood went up. It's $25 a kilogram now. So actual quantity times actual price gets you actual cost. Standard quantity times standard price gets you the standard cost. The actual cost minus the standard cost will give you the cost variance. So see, it's important to understand how to break these down. I think I just said all that. So it's there. Okay. For materials, direct materials and direct labor. There's a couple of reasons why variances happen for direct materials and direct labor. For direct materials, the reason why a variance might happen is because I purchased more materials than I actually needed. So that way I can have a balance, right? That's one reason for a variance in direct materials. Or the price of the materials went up or down. That may cause a variance in materials. For labor, the reason why a labor variance would occur is because I used more hours to produce the product than expected. Your actual quantity was higher than your standard quantity. That happens. Or another reason why you might have a labor variance is I paid my employees more than I normally do. Their hourly wages went up. That would cause a labor variance. The price, difference in price. So, those are the main factors that cause these kinds of variances. A change in the actual quantity or a change in the actual price will create a change in the actual cost. Or if there's, the standards are going to be the same. The standard is standard, right? Your standard quantity and your standard price remain the same. A quick way to figure out the variance, the cost variance, would be to take the actual quantity times the standard price. That will get you the cost variance. So, to find the cost variance, actual quantity times the standard price gets you the cost variance. First, you got to find, obviously, the price variance and the quantity variance. To find the price variance, we take actual quantity times actual price minus the actual quantity times the standard price. For the quantity variance, we take the actual quantity times the standard price minus the standard quantity times the standard price. I know it's a lot. But the standard price is the amount that we should have paid. That we should have paid. Yeah, that's funny. The amount we normally pay is a standard price. It's the amount we normally pay. Standard quantity is the amount we normally purchase. Or amount we normally use to manufacture the product. And of course, the actual is what actually happened. So to get your price variance, again, actual quantity times the standard price minus the actual quantity times the standard price. Yes, it's redundant, I know. And then the quantity variance. Yeah. It's a nice way to break it down to make the equation shorter, as they say. For the price variance, take the actual price minus the standard price. Do that part first. That's what the parentheses mean, right? Remember PEMDAS or whatever they call it? Parentheses first. Actual price minus standard price. Do that part first. Then multiply by actual quantity. That gets you the price variance. And to find the quantity variance, we take the actual quantity minus the standard quantity. Do that part first, and then multiply it by the standard price. And now that you got your price variance and your quantity variance figured out, we can put it all together. So let me show you how to figure out the variance for materials and for labor. Okay, now I guess we're making golf clubs. Why not? We already made baseball bats and we already made hockey sticks. Might as well make some golf clubs. Okay, so here's some cost information that we got. We got direct materials. This must be aluminum, I would think. Half a pound of aluminum at $20 a pound. That's $10. Okay, for the direct materials make a golf club. Direct labor takes an hour to make one. $16 an hour. Direct labor, $16. So my total standard cost per unit is $26. Direct materials of 10, direct labor of 16, 26. Now we know $26 per unit to make. We can figure out the variances. So here's how it works. We just plug in the amounts. So remember, the standard is what we expected. So the standard price is $20 a pound for aluminum. The standard quantity is 1,750 pounds. So because we need to make 3,500 units. Half a pound per unit means I need 1,750 pounds. Gives me a standard cost of $35,000. But now, things change. I purchased 1,800 pounds instead. Why? Because, I don't know, I needed some left over. Just in case, something went wrong. I need an extra 50 pounds. So, I bought 1,800 pounds. That's my actual quantity. And I managed to pay $21 a pound. Okay, the price went up. What can you do? Price of aluminum went up by $1 per pound. So I bought 1,800 pounds at $21 per pound. Gives me an actual cost of $37,800. $37,800 is different than $35,000, obviously. So my variance, I take my actual quantity times my standard price. Actual quantity, 1,800. Standard price, $20 per pound, gives me $36,000. Price variance, we take the actual cost minus the variance. So $37,800 minus the $36,000 gives me $1,800 difference. Unfavorable. Well, yeah, unfavorable. I spent more and got more, right? Quantity variance. I take my variance minus my standard. $1,000. Also unfavorable. Why? Because I got more quantity than I needed. But 50 pounds more, to be exact. That gives us a total direct materials variance of $2,800. Price variance plus quantity variance. Total direct materials, $2,800. Unfavorable, of course. Spent too much. We got too much. Well, who should be responsible for this kind of variance? Is it the engineer? Is it manufacturing? Is it the purchasing manager? Who's responsible? Well, it depends, right? Sometimes it's you. Your people work too many hours. We could have got cheaper materials, etc. Have that discussion part. For labor, works the same way. Your standard cost for labor, standard hourly rate, standard number of hours to make a golf club. Your actual cost, how many hours it actually take to make the golf club, how many hours they actually worked. And of course the variance, actual hours times the standard rate. So first we figure out the rate variance. Rate variance, all that means is an hourly rate difference. So to find that, we take the actual hours worked to create 1 unit times actual rate minus the standard rate. Remember, do that part first. First you do actual rate minus standard rate, and then you multiply that by actual hours. Order of operations, very important. For efficiency variance, this basically is the difference in number of hours. Actual hours minus standard hours times the standard rate gives us the efficiency variance. Once we do that, we can find the labor rate variance. Okay, so remember this. It's the same as before. $16 is our standard rate. $16 per hour is the standard rate. It usually takes 1 hour per unit. That's the standard. If I'm making 35,000 units, that means I'm allocating 35,000 hours. It takes 1 hour per unit at a standard rate of $16 per hour. That's a total standard cost of $56,000. I actually spent a little bit more than that. Why? Well, my employees are very efficient, so they only work 3,400 units. 3,400 hours, actual hours. But I paid them a little bit more, $16.50 per hour, for a total actual cost of $56,100. The variance is actual hours times standard rate. Actual hours 3,400, standard rate 16,000, giving me 54,400. The rate variance was 1,700, unfavorable, because remember I spent more than I had planned, so unfavorable by 1,700. My efficiency variance 1,600, favorable. Why is that? Because the actual minus the standard is higher than the actual, or budget amount higher than the actual. That's why it's favorable. This gives me a total cost variance of $100, unfavorable. Rate variance plus the efficiency variance. I'm sorry, minus the efficiency. Okay. Yeah, there's a number of reasons why I might pay them more, might pay them less. It's usually based on skill. Sometimes my employee might be higher skill, therefore they'll take less time on performing the work, but it also means I have to pay them more. Lower skill, they might take more time, but could pay them less. So there's trade-offs here, And those cause labor cost variances. Who's responsible? Is it HR? Is it the managers? Who knows, right? It's usually a combination of all of the above. And then, of course, overhead. When it comes to overhead, using the predetermined overhead rate, we can calculate the overhead rate variance. The predetermined overhead rate, as you may recall from earlier discussions, you take the total overhead costs divided by the activity base. The activity base could be number of hours, it could be some other factor. But the predetermined overhead rate times the standard activity rate will give you the assigned overhead amount. When it comes to overhead, it's what we expect at a certain activity level. Okay, so for example, if I'm at 100%, then I would expect uh, my overhead rate to be a certain amount at 100%. If it's less than 100%, I would expect that amount to be different. It's kind of like this. When we talked about the what do you call it? The ranges? That's kind of how that part works. So okay, so it's a three-step process. First is we determine an allocation base, then we choose a predicted activity level, and then we compute the standard overhead rate. Usually steps 1 and 2 are going to be given to you in any kind of question you might have. And these are the different activity rates: 70%, 80%, 90%, 100%. And then we can figure out the overhead rate per hour by looking at the number of units for production times the percentage capacity. Gives us the total gives us the total variable costs plus fixed costs, gets us total factory overhead, divided by the activity rate or activity base, which is labor hours in this example, to give us the predetermined overhead rate. If the predetermined overhead rate is at the 80% range, we would take the total factory overhead at that range divided by the labor hours at that range to get our predetermined overhead rate. In this example, $2 per hour overhead rate. And then, of course, we can compute the cost variance for the predetermined overhead rate. We take the actual overhead incurred, the actual overhead that happened during the accounting period, minus the standard overhead applied. So actual overhead incurred minus the standard overhead applied. Now, if we use the earlier example, actual overhead incurred 3,650 plus 4,000, which comes based off of that 80% rate, gets us 7,650. The standard overhead was 3,500 times $2 per direct labor hour equals the 7,000. 7,650 minus the 7,000 is a difference of $650, which is unfavorable because the actual is greater than the standard. Actual greater than the standard means unfavorable. Actual overhead incurred minus the standard overhead applied gives you the overhead cost variance. Most costs are controllable, some are not controllable. Controllable costs typically include costs within a manager's control. That's what they mean by controllable. Okay. Sometimes there'll be a change in sales, the sales amount. We expect to sell certain amounts sometimes, right? And then it comes in as something else. I expected to sell 1,000 golf balls. I actually sold 1,100. Well, that's good, right? Because I sold more than I expected to sell. The sales price was even higher than what I expected it to be. I sold each golf ball for $10.50 when it normally I sell them for $10. Uh, I sold a few less golf clubs. I sold 10 less golf clubs than I expected to sell. And my sales price for golf clubs were $10 less than I expected. So I could look at variances based off of the sales amounts. And it's the same exact method that we've been using for variances. And we're looking at actual versus your um, actual minus your standard, right? That's really what we're looking at. It works the same exact way. And we could also follow a similar variance approach when it comes to the application of overhead. So for total overhead variance, we have variable overhead and we have fixed overhead, as you know. And we can look at the variances for spending, efficiency, and volume. Actual minus your standard or applied uh, gives us variance for variable overhead. Okay, let's breeze on through this. The variable overhead variance, actual, again, actual minus the applied gives you the variable overhead variance. To find the actual variable overhead incurred, we take the actual overhead times the actual variance rate. I'm sorry, actual variable rate. Okay. And again, it's all the same method. We're basically taking the same formula and applying it to a lot of different things. That's what variance is. A variance formula, if you will. In its most simplistic form, of course, it's just your actual minus your standard. That's what's going to show you the variance. Well, there might be a few questions. They'll say, "Oh, calculate the variance." That's how you do it. It depends what it is, what part of the variance you're looking for, or what variance you're looking for. That'll be really the biggest difference. And this is what the variance rates can look graphically. And this is a nice summary of all those variances. Again, more summary. Just kind of shows you in a quick exhibit, if you will. Oh, now, when there's variances, we need to account for those variances. And so these are a couple of journal entries that we would normally make when there's a variance. So like, for example, this one shows us differences in direct materials for both price and for quantity. So this is the type of journal entry that we would make to account for those differences. And here's an example of a labor rate variance. This is the type of journal entry that we would make for a labor rate variance. And here's one for overhead. Here's an overhead variance example that we would, a journal entry that we would make to correct it. And all of those are typically done in the adjusting entry process. And that, my friends, is the end of our discussion on for budgeting and for cost variances, things like that. Any comments, questions, or concerns? Y'all good? Y'all still awake?
Yeah, I'm still awake. No too late, Professor.
Awesome.
I'm
Thank
still
you.
here,
Thanks,
Professor.
Mike. Thank you, Shanae. Okay. All right. Cool. So we just managed to force our way through chapters 22 and 23. So where are we in the classroom? We're in module 2, week 4. So for this week, you have a homework assignment and you have a quiz. Remember, 2 chapters a week. That's what happens in a 6-week course, right? So you have the exercises there to help you to apply and better understand the concepts that we talked about in class today. And of course, you have 2 attempts on every homework assignment and every quiz. I hope that you take advantage of those opportunities because, it helps you to get a higher grade and a better understanding and all that stuff. Practice makes perfect, as we say. So, take your time with it. But again, they're both due Sunday night. So, my recommendation is use the class time on Wednesday to complete the homework assignment, the quiz. Some of you have done it already, which is awesome. But again, make sure that you use those 2 attempts and just kind of understand where we are. And that's all I got for you. Hopefully you enjoyed today's sessions. As always, I'm here for you whenever you need me. You can email me, call me, set up office hours. The link's right here. Whatever you need, I'm here for you guys. Yeah, is there anything else, or we're all set? Y'all good?
I think that does it. Thank you for being available, sir.
Hey, my pleasure, Peter. Absolutely. So, as always, I want you to please stay safe, wash your hands, do the right things, and I will see you all again next Monday at 5:30. Thank you so much for your time today. Appreciate all of you. Have a wonderful night.